The First Home Savings Account is the only registered account in Canada that is specifically designed to fail. The banks and the federal government pitch this account as a no-brainer. They tell you it has the tax breaks of an RRSP and the freedom of a TFSA. They call it the holy grail of Canadian investing. But in reality, the FHSA is not a gift. It is a conditional contract with a retroactive penalty clause. The moment you sign that paperwork, you are not just opening a savings account. You are starting a countdown clock that you cannot stop. You are agreeing to a strict set of audit triggers that, if crossed, allow the Canada Revenue Agency to retroactively classify your entire down payment as taxable income. Imagine saving for 8 years, building a $40,000 down payment, and then having the CRA strip away $15,000 of it the month before you close, simply because you missed a deadline on page 4 of the tax code. That is the reality for thousands of Canadians who treat this account casually. Today, we are going to disarm this account. We are going to build a forensic compliance framework using a simple 4-box protocol. And we begin with box 1, the fuse. We will calculate the exact expiry date that burns your contribution room if you open the account too early, and why starting early is actually a mathematical error for anyone under 25. Next is box 2, the audit trap. We will uncover the written agreement rule and the relationship clause that disqualifies thousands of buyers who accidentally move in with the wrong partner. Then we expose box 3, the laziness tax. I will show you how big banks quietly skim 2.5% of your down payment through hidden fees, and the specific tool you need to bypass them to keep your yield for yourself. And finally, box 4, the ghost room. The secret weapon to create phantom contribution room for retirement, creating a tax shelter that exists outside the normal limits of the Income Tax Act. Let's begin the audit with box number 1. Box number 1, the timeline. Your TFSA is forever. Your RRSP is effectively forever. But the FHSA is temporary. It has a self-destruct mechanism built into the legislation. The rule is rigid. The account can only stay open for a maximum of 15 years, or until the end of the year you turn 71. This creates a massive strategic dilemma that most young investors get wrong because they are operating with a savings mindset instead of a compliance mindset. I see 18-year-olds opening an FHSA just because they can. They put $50 in to get it started because some TikTok advisor told them to. The problem is, they have just lit the fuse. If you open the account at 18, it legally must close when you are 33. In the modern Canadian housing market, 33 is young. If you are still renting at 33, perhaps because you are finishing a PhD, or you live in Toronto where the average detached home is $1.5 million, the account closes. The opportunity is burned. You are forced to roll that money into an RRSP, and you lose the tax-free withdrawal right forever. Now, let's look at the math of contribution room, because this is the second part of the trap. You accrue $8,000 of room per year, up to a lifetime maximum of $40,000. But, and this is critical, the room only starts accumulating the year you open the account. This brings us to the carry-forward trap. You can only carry forward 1 year of unused room. Let's say you open the account in 2024, but you are broke. You ignore it until 2027. You might think, great, I have 3 years of room piled up. I'll dump in $24,000. Wrong. The CRA only allows you to use the current year plus 1 previous year. The room from 2024, it evaporated. It is gone. So, the rule for box 1 is precise. Do not open the account until you are ready to commit capital, but do not wait so long that you lose the carry-forward window. It is a timing game. Now, let's move to the top right quadrant. Box number 2, the audit trigger. This is where the CRA waits for you to slip up. You see, the government hates giving away tax revenue. The FHSA is a massive tax break, so they have surrounded it with tripwires. To withdraw tax-free, You must be a first-time homebuyer. Sounds simple, right? Here is the relationship trap. The CRA definition of a first-time buyer includes your spouse or common-law partner. If you move in with a partner who owns a home, and you live together long enough to be considered common law, which varies by province but is often just 12 months for CRA purposes, you are no longer a first-time homebuyer. You could have $40,000 saved in your FHSA, ready to buy your own place, but because you moved into your boyfriend's condo for a year, you are disqualified. You cannot access the money tax-free. You are locked out of your own down payment. But the harder part, the part that catches people during the closing process, is the written agreement rule. To make a qualifying withdrawal, you must have a written agreement to buy or build a qualifying home with a completion date before October 1st of the year following the withdrawal. Let's paint a nightmare scenario to show you how fragile this is. Meet Sarah. Sarah finds a house. She withdraws her $40,000 tax-free to put down a deposit. She feels great. But then the inspection comes back. The foundation is cracked. The deal falls through. Now, Sarah has $40,000 sitting in her checking account. It is no longer in the shelter. If she does not find and close on a different house by December 31st of the following year, or deposit the exact amount back into the FHSA, that $40,000 is added to her taxable income. She didn't buy a house, but she just got hit with a $15,000 tax bill. To check box 2, you must treat the withdrawal with extreme caution. Do not touch that money until the conditions are waived and the ink is dry. Okay, quick pause. We are wading through dense tax code here. I know this isn't the most exciting topic, but it is the difference between keeping your wealth and donating it to the government. If this breakdown is saving you from a paperwork error, do me a solid and hit that like button. It helps the algorithm warn other Canadians before they sign the wrong form. Box number 3, the laziness tax. Most people volunteer to pay this because it feels convenient. They walk into their local branch, sit down with a nice advisor, and sign whatever is put in front of them. Here is the math of convenience. If you walk into a big bank, they will likely put your FHSA into a mutual fund. The average retail mutual fund in Canada charges a management expense ratio, often over 2%. On a $40,000 down payment, growing over 5 years, that 2% fee strips away thousands of dollars of your gains. Think about that. That is your new furniture budget. That is your legal closing fees. That is your welcome tax. You just burned it because you didn't want to open a different app. You have to get out of the mutual funds. The FHSA is short-term money, usually 3 to 7 years. You need to buy raw assets like high-interest ETFs or GICs directly to protect your principal. This is why I personally use WealthSimple for this specific account. Now, are they the only option? Absolutely not. You can use Questrade, National Bank, or Disnat. They all allow you to buy ETFs for free. But here is the difference. Zero friction. National Bank and Disnat often require minimum balances of $15,000 to $20,000 to waive their annual admin fees. If you are just starting your FHSA with $8,000, those fees eat your yield. WealthSimple has no account minimums. You can start with $1 and the fee is zero. I don't care which platform you use. Just stop donating your down payment to the bank. I've left the link to the fee-free setup below. Use the tool that fits the math. Finally, box number 4, the ghost room. This is the secret weapon. This is the reason why every single renter in Canada, even those who plan to rent for life, should open this account. There is a massive fear among Canadians. What if I fill this account but I never buy a house? Do I lose the money? The answer is, it doesn't matter. If you hit the 15-year limit or you just decide you prefer renting, you can transfer the entire balance, principal plus growth, tax-free into your RRSP. Here is the magic. This transfer does not use your RRSP contribution room. I call this phantom room. Usually your RRSP is capped by your income, but the FHSA allows you to create an extra $40,000 of room out of thin air. This means you get the tax deduction today, tax-free growth for 15 years, and then a massive injection into your retirement fund that bypasses the normal limits. It creates a super RRSP. Even if you never buy a shack, this account is mathematically superior to a standard RRSP for the first $40,000 of savings. Now, once the money is in the account, you have one final problem: asset allocation. Most people treat the FHSA like a TFSA and buy stocks. That is dangerous. If your timeline to buy a home is less than 3 years, you have no business being in the stock market. If the market drops 20% right before you find your dream home, your down payment is gone. You need return of capital, not return on capital. You should be in GICs or money market funds like cash.to. Only buy stocks if your timeline is 5 years or longer. The FHSA is a power tool. Used correctly, it accelerates your wealth by creating tax deductions and a phantom room. Used incorrectly, it triggers audits and tax traps. If this deep dive helped you navigate the minefield, please hit that subscribe button. It ensures you see these warnings before you make the mistake, not after. Now the question is, should you fill the FHSA before the RRSP or before the TFSA? Most Canadians get this order of operations wrong. We broke down the exact math in our RRSP trap video. Watch that next to ensure you aren't saving money today just to lose it tomorrow. This video is for educational purposes only and is not financial advice. Always consult a professional before making investment decisions.